You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. It's good to hear that music again. I haven't had a chance to hear it in some time. Welcome back to the Option Block, everyone's favorite. I know it's my favorite. Hopefully it's your favorite bi-weekly source for all things options related. A little bit of options wit and wisdom, some hilarity, some education, some strategy, some unusual activity, and your questions. Mix it all together. You got the tasty, tasty, delicious meal that is the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. You might say, hey, where's that guy been for a while? I've been out gallivanting hither and yon, up and down the West Coast there, out for the big Options Industry Conference. It was in Los Angeles last week, and as always, a very interesting event. A lot of interesting developments. We'll get to some of those in a little bit, but of course, you can always find all of our goodness, including all of our content and coverage from the Options Industry Conference. The best place is, of course, the flagship, theoptionsinsider.com. You actually click on the top of the site there. You'll see a little tab that says OIC. Click on that, and all of my interviews from that event, as well as all of our panel audio, which is forthcoming. Maybe even by the time you hear this, all the panel stuff will start trickling out to the network. So if you missed the event, I know a lot of you guys can't make it all the way out to LA to check out an industry conference. Well, we got you covered. We got all the panels, as well as a lot of other great content coming from the show. So a lot of it's already hit the network. Others coming soon. If you just want the panel stuff, first off, you're listening to the wrong show. But secondly, of course, you can always just grab our special events feed as well. It has all of our panel content in there. So good stuff. Check it out wherever you find your favorite Option Insider programs, iTunes, TuneIn, Stitcher, and so on and so forth. And joining me on the old Option Block program today, that did an able job holding things down while I was traveling hither and yon, starting off with the man beaming in from the great principality known as Maine. You know him, you love him as the Rock Lobster, Mr. Andrew Giovinazzi. Andrew, welcome back to the Option Block program, sir.
It is lovely to be here. I did enjoy the hosting chair for the short time that I had it.
It's comfy, isn't it? It's not like the Iron Throne. You make it a little more comfortable there. No sharp swords to stab you in the butt while you're sitting down.
Yes, it is much more comfortable than one would imagine.
Also, no one looking to murder you and take your place, so that kind of helps a little bit with the comfort as well. Unlike the Iron Throne. Again, a Game of Thrones reference if those of you out there haven't been watching the show. And also joining us from a little bit closer to home via the little sweet hamlet known as St. Charles, Illinois. We are joined by Uncle Mike Tussaw from RCM Wealth Advisors, a.k.a. RCM Alts. Uncle Mike, welcome back to the program, sir.
Always good to be here from the hamlet.
Indeed. Thankfully, though, you're not as melancholy as the Dane. All right, with the team assembled, we're going to keep on rolling right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody, welcome to the trading block. Like the name implies, this is indeed the portion of the program where we break down what was moving, what was shaking, what was rocking, what was rolling in today's market activity. And we close the day off ever so slightly on the day, about 0.3 of a percentage point out there in the old S&P. But that's about 16 handles off the lows. The S&P closing right about 2041, getting down as low intraday as about 2025 or so. So the end of the day, not really telling the full story. We had the full scope of Sturm und Drang here in the market today, a sell-off and then a bit of a rally intraday, only to end up off mildly on the day. Yet another one of those days. And of course, all of that froth back and forth gives a little bit of green to the old vol screen. In this case, the VIX cash hovering in the mid 16 handle range, right around 1640 at the end of the day there or so. So a lot of things for us to dissect. Perhaps we'll start in order of distance, go way the heck out there to the duchy, nay, the principality, the kingdom of Maine. Mr. Rock Lobster, what caught your eye in today's back and forth activity, sir?
The annoying Fed. Has that ever been a topic on this show?
I don't think that's... What is this annoying, Fed you speak of?
We are going to... you know what? Anybody who had little kids, you had Sir Topham Hatt, and he would always say, tell Thomas, you are causing confusion and delay. And that's what I feel like every Fed announcement is.
That's a perfect way to describe them, actually. Janet Yellen is Sir Topham Hatt. I love it.
I am causing confusion. The whole thing is just raise the rates already. Yeah, the rest of the world is trying their QE crap. They all know it doesn't work anymore. They keep trying it, so just raise it. Stop saying we will, we won't, we will. It's like stupid. Oh my gosh. Anyway, so I think though maybe it's an unintended consequence, or maybe Janet Yellen is totally brilliant. I'm going to give her the benefit of the doubt that it's possible. She's like, you know what I'm going to do? I'm just going to make the equity market and the bond market totally punch drunk and confused. And I'm going to make them all so confused, they're just not going to give a damn anymore about what happens with rates. And then I can raise them when I will, and I'm not going to cause any problems. And because everybody's so used to it, because we had the sell-off today, there were no materials. It didn't materialize. The VIX futures, I think, are going to close unchanged, unbelievably, because they've already been bidding some of this in. And it just, okay, so they might raise in January, whatever they're going to stinky little raise is going to be, or June, and that's it. So I think it's like they almost say something that's confusing, then they spend the next week trying to reiterate, hey, we're not trying to be confusing, we're just trying to do this. And, the first reaction the market always has is sell, Mortimer, sell. That's where we are. So I would not be surprised to see volatility where it was earlier in the week. I would not be surprised to see that happen by maybe Monday, Tuesday of next week. And, there's some takeover activity. We had good earnings with Wal-Mart, good earnings with Cisco. Besides basically retailers that have been competing with Amazon, earnings haven't been that bad, although, lower than last year. So, and the equity market's lower than last year. So unless, unless central bankers kind of go crazy and instead just start pulling back on all the QE, which it looks like Japan, looks like the spigot is kind of now stopped. They try to go crazy and then it stopped. The EU saying, maybe there's a limit to this negative interest rate thing. So the U.S. is definitely trying to get rates up slowly, however long it takes. And the rest of the developing world is basically going to give up on whatever's left of QE and go on. So it looks like the equity market today, I think this was kind of a good flip-flop on that, saying, well, okay, let's do it and see what happens. That's right.
I think the Sir Topham Hatt one might be the best synopsis for the Fed I've heard in quite some time, because that is exactly what they're doing. They're causing confusion and delay, and add a little. If he'd have said, and you're also adding volatility, he would have been perfect. So.
I think maybe that's the title of the show. Sir Topham Hatt says You are causing confusion and delay.
I have to just figure out by the end of the show how the heck to spell Topham, and then we're good to go. I haven't watched Thomas.
I think it's Topham.
Oh, there we go.
Topham Hat.
There we go. I think we're gonna get sued by the ever litigious folks who run Thomas now. All right, let's escape from that very quickly before their lawyers come to find us, and instead return to the sleepy hamlet where the Dane awakes us, aka Uncle Mike Tusaw. Uncle Mike, in addition to all this hither and yon with the Fed, and aka Sir Topham Hat injecting themselves into the narrative once again, what else caught your eye in today's activity, sir?
Well, it feels like it's the first day in a while that we haven't touched the 205 mark, either for better or for worse in SPY. I was talking with Andrew on the show on Monday, and it just seems like we're just glued to 2050 on the SPX and 205 on SPY. We just can't get away from that number. But today we did not touch it. We actually went below it. We gapped below it, of course. Yesterday's close, of course, being I guess we didn't technically gap below it. Yesterday's close, of course, being 204.91. But with that, it was kind of interesting in that we weren't at 205 at any point during the day today. So that's one thing that caught my eye. The other thing that caught my eye was just the lack of movement in the commodity space, and more specifically gold and oil. Yesterday, after the Fed made not their announcement, when the minutes came out, and it looks like they're possibly doing a rate hike in June, good old Sir Topham Hat. When that happened, we had a sell-off in gold. The sell-off did not continue today, and I'm actually a little bit surprised by that, to be altogether honest, but nonetheless, it is what it is. I'm still looking to sell some puts in GLD. It still hasn't come down to my liking as of yet, but I'm hoping that patience is rewarded along that front. But the main thing that I would say did kind of take me by surprise was just XLE, for example, is up 1 penny on the day. Oil is down 19 cents on the day. So that is probably the main thing that caught my eye, just for not necessarily anything exciting, but the lack of excitement within those two products. I shouldn't say that. Oil did come down a little bit during the day, but nonetheless, the lack of ending excitement in those products.
Yes, end of day excitement, to be specific. A couple other things catching our eye, a lot of other things catching our eye out there in the market before we get to some interesting developments coming on the heels of the big options industry conference. First off, we've said before, at least I've said before on this show, whither go McDonald's and Wal-Mart, so go the economy. One of the reasons we turned around here today is because before the open, we had Wal-Mart coming out with some surprise revenue growth, showing perhaps a little bit more strength than some people expected out there in good old WMT. They ended the day up nearly 10%, about right, hovering a little bit south of the 70 handle out there. So a good day out there in Walmart. And of course, people are spending in Walmart, kind of a decent sign for the overall economy. And also on the perhaps less healthy, more hyperbolic side of the fence, we come to Tesla. I'm not sure if Walmart and Tesla have ever been uttered in the same sentence before, but c'est la vie. Not exactly two names you think of in the same breath, but Tesla. This is another interesting one. The hype, Mr. Rock Lobster. This must attract you. Must have been in your chat room today, I'd imagine, as well. Just the notion that Tesla, all this concern about how they're going to produce so many cars, how they're going to do it. Well, one of the ways they're going to fund it today, they're going to sell about $1.7 billion worth of stock, so they can have some capital. That $300 million or so, whatever the public loaned them for their pre-orders, wasn't enough to cover ramping up to become a major car manufacturer almost overnight. So nearly $2 billion worth of stock. And of course, what does the stock do on this news, Mr. Rock Lobster? It rallies nearly 2%, because why wouldn't it? Dumping $2 billion worth of shares on the market, that's not gonna dilute anyone, right?
You know what? I remember them doing this when the stock was like $98 or something like that, and everybody thought it was wildly overpriced, and Elon Musk sold the stock, and the stock went up $20 after the IPO or the secondary. So, holy gosh, I cannot. You can't fade that guy, because he seems to be able to. If anybody can walk on water and chew gum at the same time, it's that guy. He just He's got it all figured out. I don't know how he does it.
They have mastered hyping that stock. I mean, I've never seen dumping $2 billion worth of additional stock rallies the stock before. It's crazy town. It should not fundamentally be possible. And yet somehow it is. To a diehard fundamentalist like you, Mr. Rock Lobster, that should be deeply, deeply offensive. On the other side of the fundamental side, we have, of course, on the technical analysis side, an area we've poo-pooed, to put it mildly, in the past here on the program. But not that we're not oblivious to all these things. A lot of people were tweeting back to us and retweeting a link we put out earlier in the week from Bloomberg. Actually, they put out some article. I think a lot of people like it because there's like the name, the Death Cross. But a lot of people, a lot of hand wringing over the S&P coming to essentially hitting that death cross limit, which you're not familiar with that. That is the 50-week moving average falling below its 100-week moving average. That's termed to be easier for me to say, statistically significant death cross. Only happened twice in the past 2 decades. The first time in 2001, followed by a 37% decline in the index, and then a second time in 2008, followed by a nearly 50% drop in the S&P. So Uncle Mike, as our resident technician here, as well as our resident bull, what are your thoughts? Everyone seems to be doing a lot of hand-wringing about this death cross. A, you pay attention to this stuff, and B, what are your thoughts for obviously it spells imminent doom for the market henceforth?
No, I can never say I've really paid too much attention to a specific death cross. However, that does make a really good headline. If you hear the word, like you said, if you hear the word death cross, how can you not want to read something like that? But my general rule has been, if we're negative on the year, be very cautious, have minimal deltas on the table, and be fearful. If we're positive on the year, put a little bit more on, be a little bit more aggressive. And as we get more positive, re-ratchet the number to when we get up, say 5% or 10%, whatever your personal rules dictate. So with that, I'm not a fan so much of the death cross or things like that. You look at them from time to time. I'm not denying that. But the reality is that numbers trump geometry any day. And yeah, you might have had a great technical breakout, but if your account balance goes down, who cares? So in terms of the death cross, not paying much attention to it, but definitely paying attention to the numbers in SPY, which I always do.
Speaking of paying attention to numbers, we do still have a few earnings managing to make their way out after the bell here, and one of them being the retailer Gap, of course, good old Mr. Sebastian. Shame he's not here because he loves all of the ladies' clothing retailers out there. Gap looking pretty decent in the after hours, up about 50 cents or so. They actually closed here. If I can get my suite to play along with me, there we go. Closing out about 17.30 or so, and gapping up a little bit here in the after hours, at least so far. They were up a lot more earlier. It looks like they were up about over 5% on the news. Now they're settling back down just about 40 cents. So maybe, I guess, the initial flurry of love for Gap perhaps fading a little bit here in the after hours. But you know where the love isn't fading, guys? One thing I wanted to bring up, coming here on the heels of OIC 2016. You'd think here in 2016 the love for open outcry options trading would be kind of at its nadir, as death knell. Speaking of death crosses, we crossed that death cross for open outcry and options. You'd think a long time ago, and yet perhaps you would be mistaken. Not only did they announce plans for the 15th overall options exchange coming by the end of the year at OIC 2016, coming out of our friends at MIAX. They feel left out. They only have one options exchange. Now they want to have two. But also our friends over there at BOX, the Boston Options Exchange, saying, you know what? We want to get into this whole trading floor business. So they're going to add an open outcry trading floor in Chicago. It's confusing, I know. The Boston Options Exchange run out of Chicago, but c'est la vie. I made my peace with it a long time ago. You'll have to do it as well. They're going to add an open outcry floor. Of course, Amex still has an open outcry floor. SIBO, of course, infamously has still a huge open outcry presence for SPX and VIX and others. Even the folks over there at NASDAQ who run Philly, they're doubling down on the Philly floor. They're in the process, I was talking to them at OIC as well, they're in the process of expanding the Philly floor and moving it to a brand new facility. They were telling me about how they're going to have all kinds of stations. They even told me they added 2 floor brokers in the past year, which to me was just insanity, but it's amazing. New floor brokers in 2016. But so apparently, Mr. Rock Lobster, you and I announced the death knell of options too soon. Of course, on the futures option side, CME just closed pretty much all their floors in New York. So I guess depending on the product you're looking at is how it goes. But what are your take here? 2016 and apparently a plethora of new trading floors coming our way in the near future, Mr. Rock Lobster.
I guess it seems like it. There's still, options, strategies. I have Option Pit. One of our clients became a market maker on the PCX, and he still trades a fair amount of paper. There's only 20 locals anymore, if that, like 18 or 20 locals. So all the paper that used to go to 500 locals go to 20, and it's mostly just bigger stuff that's crossed. Everything else is electronic.
He gets actual walk-in paper still.
Oh yeah, totally.
Wow, that's amazing. That's
yeah,
awesome.
I'm gonna cross 3,000. We'll give the crowd.
What's your market? Okay, I'm gonna cross it on your bid, and you get 10.
Exactly, but they don't complain. They're like, okay, whatever.
I'm not cynical at all.
But it's it's still viable. There's still something going on there. It's obviously not what it used to be or what I found exciting, but it's still happening. Let's put it that way. The fact I think what's happening is these guys want to open these floor crossing exchanges, basically to try to get out of some of this huge institutional paper, because of the all electronic exchanges, they're not going to post something and have somebody just take part of the order or something like that. They want the order flow filled. And if you have an electronic exchange, like all these poofy electronic exchanges that only provide, 40 lot liquidity or something like that, it doesn't matter to a fund that wants to trade by 2,000 or something. So somehow they think it's going to help them in that game, because the Philly seems to be running away with sort of the block trading. So I can see why we need another exchange. I guess there's a business case for it. It's hard to believe all these exchanges are making enough revenue to actually spend the money on more infrastructure. But what the heck do I know? I'm not on the floor anymore, so I'm just an off-floor guy at this point.
We're just cynical and beaten down in our old ways. But Uncle Mike, this could be an opportunity for you. You missed the heyday of floor-based trading and market making. Here you go. Now you have myriad opportunities to get back in there. You too could join the fun on the box trading floor. You can go SIBO if you want. Maybe you can travel a little bit and go over to Philly. So there you go. Has this piqued your curiosity at all, Uncle Mike?
When Mike Cavanaugh and I first got together 7 or 8 years ago, we were always talking if the floor ever did come back, which we have never been really holding our breath on it. But one of the things that we were looking to do in the future space is possibly have one of us go down there and do something in terms of creating some revenue and that type of thing. So it was kind of one of those things to where we both kind of looked at ourselves and said, okay, well, if that happens, great. And if for some reason we can invent a time machine too, we would try and make money on that. We kind of put it in that category. But if I really felt that it was a viable plan, and if it was like, as all you floor traders say, if it was like the old days, then heck yeah, I'd be down there right away. And I'm sure you guys would be too. If it were like it was back in the old days when you can buy at the bid for $1.20 and sell at the offer for $2.90 and do that all day. But I don't know if that's the way it's going to be. So not really holding my breath on it, but I do have to say I should just go down there for like a day and do like what Kevin Bacon did and make one floor trade, so that way I can say that I'm one of you, so to speak.
Well, he just did it on a visitor's badge. You don't even need to register.
Yeah.
You just walk in, slap on a visitor's badge, and then start slinging size on earnings day. That usually works out pretty well, I've seen. So people like to honor those visitor badges. They have an inherent contract behind them. I think that's a good plan, sir. Go forth and prosper. Meanwhile, we're going to go forth right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for The Odd Block.
That funky tune means it's time for the weird, the wild, the unusual, the downright unseemly portion of the show. So if the children are tuning in, just cover their ears because we're going to get dirty into the weeds, the dark side of the options space. And when you think dark side and shady, you instantly think KCG Holdings, ticker symbol. Of course, KCG appropriately. This is, of course, closing today, $13.22, off about 8 cents or so on the day. And this is a name that actually I typed in the wrong symbol. I was teasing. As I besmirch the people over there at KCG. KGC is actually the ticker I want to talk about. KCG folks, very nice people. KGC, which is Kinross Gold Corporation. This is, of course, our resident cheapie for the day, sub $5 name, closing today $4.93. Pretty much fractionally unched on the day. This is the name that does, brace yourself, listeners, a whopping 12 contracts a day, doing today 31,711. So a little bit of paper out here in good old Kinross Gold. In particular, the calls are what caught our eye today, to the tune of about 27-1 calls over puts. And leaving aside the debate of whether a $5 stock is indeed an option in and of itself, we turn our attention all the way out to some longer-term paper, this time all the way out to the Nove 5 halves. Yes, I said it was closing today, $4.93, and someone loving themselves some Nove 5 halves. We started watching these this morning, going up over there on bats in one chunk, starting with about 16,000 contracts. As the day went on, a total of about 23, almost 24,000 going up on the day. Pretty much just lifting offers wherever they could get them across the bats and some other exchanges. Even though there's size paper here, it didn't seem to appear to be any size stock component going up with it. So it appears to be really what it seemed on the surface. Just someone wanting themselves some Nove 5 halves, willing to pay 64 cents for that privilege. So again, you could argue maybe the merits, the pros and cons of paying over 10% of the value of the stock for an option that's going to expire in a few months. But I'll leave that to you guys out there to debate amongst yourselves. Again, a total of about 23,000 going up, only about 3,400 open on this strike. So clearly, this is opening paper. This is the name that does some decent volume today here, as out here doing about, I said normally about 12 contracts a day. Again, 31,000 today. So pretty active stuff. And it seems like this really just lit it up out here today, because there was paper pretty much across the board once these calls started going up, and calls and puts everywhere. But again, the lion's share out there in those Nove 5 halves. Mr. Rock Lobster, take us home here, sir. What caught your eye in this size call frenzy in KGC?
Bye. I don't know how else to say it. There was similar paper. We'll cover that, I think, in Coeur Mines. But this is I saw the 60 cent. They started buying calls right away and just didn't stop. That's all I can think of. Just taking every 60 cent offer, and they traded 14,000 of them. And the only I could think of is, it's funny because Mike said I was surprised that gold didn't do too much, but it's just it just looks like straight call bars. Somebody could be short stock against it. Maybe the continued blast off in the gold miners is going to happen, but I think just as of right now, it's all call bars all the time.
And you were mentioning to me too, my screens are showing me an ADV of 12. That seems low. Is yours is showing something different?
9,000.
That would make more sense because I'm looking at all this paper here.
I think I wrote it up as 9,000, didn't I?
I'm just saying, I'm looking here at all the paper, and there seems to be a lot of paper going up for a name that does 12 contracts a day. So clearly, my my analytics suite here today deciding not wanting to play ball. We'll see what we can do as we soldier on here with the old odd block into another newcomer here on the old odd block. This time, Coeur Mining Inc. Ticker symbol CDE, another resident cheapie, though a little bit more expensive than our previous friend. $7.77 is the closing price, so lucky sevens here, up about 2% on the day. This is the name that does, again, you know what, I'm getting, I think ADVs are off today on my platform, Mr. Rock Lobster, I'm getting an ADV of 12 for this one as well. So we're going to ignore the ADV. I think the ADV is actually about 7,700 in this name. A little birdie may have whispered that to me. And today doing about 17,000. I guess everything today did not do 12 contracts in the options market. About 18-1 calls over puts. That should, again, draw your attention toward where we saw the activity. It was indeed on the call side. And indeed, once again, Mr. Rocklouse, a little bit of a theme. Longer-term paper catching the eye of the market out here. And this time it was the Dees 9s. Before we had a stock under $5. Someone gobbling up the no 5.5. This one's under $8. Someone gobbling up the Dees 9s here. We started seeing them just about 1,000 or so going up. Paper buying them for $1 even. As the day went on, the buying frenzy continued with about nearly 15,000 total going up on the day. These calls went out $1.15 at $1.20. Again, reflecting a bit of a rally in the underlying. Also, just the size love for these things out there in the marketplace. Only 151 contracts open. So clearly, this is all open in paper. There was a size 110 bid going out there for a while on these things. So our friend here could actually be bid for more. It could be him there. 115 at 120. Again, that's a pretty tight market for these, so I'm guessing he might indeed be bid for more. Didn't see any stock or anything else going up with this bad boy, so it appears to be what it is on the surface, Mr. Rock Lobster. Someone's got to get themselves some of that gold, to quote Goldfinger.
Yeah, you remember, what was it? I think it was almost January when gold was in the basement and somebody bought a bunch of, it was like 19 or 20 level calls in GDXJ, and we were, or was it GDX? Like, there's no way that thing's ever going there. And GDX is 24 and GDXJ is 36.51. So I guess it can go there is the short answer. So it just, I think, feels like there's more pent-up action for the miners. That's the easy way to look at it. It looked like originally like the one offer, somebody came to sold these for $1 like it was a buy right. And then they just took off. Buyers came in, and I think the calls are 115 bid going out, which is kind of crazy when you think about it. They're actually bidding these calls higher than when somebody sold them down. So somebody wants them. That's all I'm going to say on that one. And, open interest of 150 contracts and 15,000 trade or near 15,000. Maybe some consolidation in the industry. Who knows? But just crazy buying, crazy call buying.
And if you're tired of calls, well, don't worry. We got you covered with some put action out here. Going to wrap things up. If you're not tired with gold, though, I can't help you here because we're still staying in the gold refrain with the market vectors gold miners ETF, ticker symbol GDX, closing today just a tick under $24, $23.96, up about 40 cents or about 1.7% on the day. This is the name that, according to my platform here, Mr. Rocklobster, guess what it says the ADV is? 12 contracts a day. This name only does 12 contracts a day. Doing a whopping 300,000 today. So actually the ADV is a little bit higher than that. Normally 118,000, but yes, my screens are telling me 12. So a little bit more than that today, about 302,000 to be precise. 250 on the puts, about 5-1 puts over calls. That should draw your attention to where it drew ours today. Not as far out this time as a no over D's, a little bit closer to home in terms of July. So a nice midsummer put love in particular. Looks like bit of a sizable put roll. It was the July 23-24 put spread going up when we started seeing this about 15,000 times. And then as the day went on, a total of 50,000 of this spread went up. Looks like there's about 52,000 open on the 24, so it appears to be they're just rolling down one old handle out to the 23s. 24s now in the money. I guess they decided they want to have a little bit more out of the money strike. Looks like they were long 24s, blasting those bad boys out and gobbling themselves up 50,000 of the 23s. Total of 100,000 contracts in this one mega roll. Either this guy is looking to take some money off the table, Mr. Rock Lobster, and adjust to a little bit more out of the money strike, or perhaps that he just loves his broker. Either way, sizable stuff, no stock or anything else with this. So it appears to be what it seems like on the surface, a size roll from someone who's very fond of his broker, Mr. Rock Lobster.
Yeah, I think this is because there was May 9th or May 5th, there was a lot of paper similar to this. I think because GDX sold off from like the 25 level, they own the puts, they're rolling them down. And it's actually more consistent with like a two-saw type thing where, you know, you own the underlying, you own some puts, the stock tanks. You're not going to get rid of the underlying, but you're going to roll your puts down and take some dollars off the table. It looks like that's what this person was doing. And I guess there's nothing wrong with that as a strategy. So it's what it feels like. I'm not sure it is just a straight put buyer. It feels like there's some stock against it, but I could be wrong. Maybe because the fact that they didn't get the continued sell-off that they've had over the last couple of days, and that's why they rolled them. So, but be that as it may, it definitely is a continuation, and so far it's been right. Now the other puts, this was a successful roll too, so their timing's been pretty good, at least the way I look at it so far.
All right, so we have to leave it on the love your broker tip. Do you love your broker? Would you do 100,000 contracts for him? Well, apparently our friend here in GDX really fond of his broker. Either that, he just really wanted that one handle down strike. We'll never know, at least maybe until tomorrow. But we have to keep rolling with the old program. Actually, it's Thursday, so I guess it's time for you guys to take the reins. Here I was all in the mood for some strategery, but my clock is off because I've been traveling hither and yon. So let's dive into the old mailbag and see what you guys have up your sleeves. The mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. Like we said, it's Thursday. Time for you guys to ask your questions, give us your comments, your pearls of wisdom, not just for us, but for your fellow Option Block listeners as well. No shortage of ways for you guys to do just that. Via the app, via our website, via all of our social media platforms, Twitter, Facebook, StockTwits, so on and so forth, even via our live stream if you manage to tune into us live here on Thursday. By the way, I know we've been screwing you guys up with our live streams. We've been doing them. We haven't been doing them. It's been a lot going on here of late. In fact, I'm going to be out of the studio again tomorrow, so no live stream for Vol Views, unfortunately. But we'll get back to you with more regularly streamed content coming up soon here on the old program. Let's kick things off. We got a little bit of time to see how many we can get to. Let's start with this one coming from 777. He or perhaps she writes, with commodity-based ETF options, is there any way to trade the roll risk? This is kind of a broad question. You know, we've maligned on this program in the past, unfairly or perhaps fairly, depending on your point of view, a lot of these commodity-based ETFs, because they are impacted by that very issue, you know, the roll risk. You know, name the product. VXX is kind of the most infamous, but it cuts across a variety of different commodity-based ETFs that attempt to replicate some sort of futures position in an ETF, a securities account. They always are usually impacted by the term structure of those futures, usually negatively. One of the ones we like that doesn't have that problem is GLD, because they, of course, hold the physical, so that's a little bit of a different beast. But we see this across the board in a wide variety of other ETFs that attempt to replicate some sort of futures options position. We see it again a lot of times in the volatility ETFs as well. I think the easiest way to say maybe I think he wants any way to avoid the role. That's probably what he's asking. The easiest way to avoid it is just not to trade a lot of these things that are horribly disenfranchised. Stay away from the ones like indeed the VXXs if you're going to be holding it for anything longer than a few hours or one session at the most. These are not long-term trading vehicles. That's going to hurt you in the long run. You're not going to, if you want a little bit of allocation to volatility, don't buy VXX and put it in your IRA and set it and forget it for a year, because I don't think you're going to like how that's going to turn out. We've seen a lot of these ETFs attempt ways to try to deal with the roll risk themselves. We've seen some that attempt to do baskets of futures. Maybe they'll mix, instead of just buying expensive longer-term ones and selling cheap ones and getting crushed by the roll yield on a regular basis. They'll make a little bit of a hodgepodge. You're picking some in the middle, some in the back, some in the mid-curve, and trying to mitigate that risk. But then you're getting into a lot of active managing there. It's a bit of a challenge to try to mitigate that. So we've seen a lot of different ways that ETFs have tried to deal with them themselves. They're not idiots. They know this is a problem. But I've yet to see one that really effectively handles that. I know, Mr. Rock Lobster, you like to slam things like VXX because you call it predictably crappy, but in that sense, the predictability is actually kind of nice. You can put VXX puts in your IRA and have them there for a rainy day down the road a little bit. But aside from loving some VXX downside, what do you tell your clients when they come to you? Maybe they want to trade, I don't know, a Bale or some other volatility product or some other, USO or some other product that has some issues with roll yields. What do you typically counsel them in that scenario?
Holy gosh, that is a loaded question.
Yes, that's a good one.
We have so many webinars and things on that. Just basically, the roll yield products all create unique, let's just call it, opportunities. So I just think they trade certain ways. So when the market's going up or down, and depending on what the value of the underlying for the whatever the product is, like VXX trades on the VIX futures, and sometimes the futures are doing things that are good for VXX, and sometimes the futures are doing something that are bad for VXX. So we just teach them what that is, and also since they move in certain ways, the product moves in certain ways. So there's a lot of just trying to figure out how the product works before you can trade it. I don't think it lends itself to all the sort of normal ways people evaluate financial instruments, because the underlyings are all reverting products that have a lot of goofy built into them. So if you don't understand what makes it goofy, you're going to have a hard time trading them. That's the easiest, simplest way I can describe it.
Yes. Uncle Mike, anything on this issue? You encounter this. Obviously, you trade some ETFs. You mostly trade GLD, so you're kind of insulated from that perspective. But you ever flirt with some others and have some clients ask you this question?
All the time, in terms of clients asking me the question. You have to, I think Andrew said it best when you say you have to understand the goofiness, because there's going to be different goofiness with each product. So have an understanding of how the roll works, why the roll works, when the roll works, and how it could be beneficial or detrimental to trading the product, being both bullish, bearish, or on the underlying or on the volatility within that underlying. So I think that having an understanding is the key. In terms of if I'm bullish, like right now, you guys have heard me say a million times how bullish I am on oil. I don't own any USO. I don't own one bit of it, just because of the fact that I don't think it's an accurate depiction of what I'm hoping that oil does over the course of the next 3 to 5 years, because I don't think USO is going to match it. Now, it's not necessarily USO's fault. They're doing the best they can, but it's a difficult thing to match. So I think that if you want to have some type of long-term exposure to a commodity and you're not able to go the futures route, then I think a commodity-based stock would be the way to go, with the exception of GLD and SLV, because they actually own the physical underlying. In terms of the short term, you could do it that way, but if you're going to go the short-term route, and if you want to actually trade oil, you want to trade, corn, you want to trade soybeans, or whatever you're looking to do in the commodity realm, open up a futures account. And if the risk is too much for you within trading the underlying futures contracts, buy some calls or buy some puts. If that's too much for you, then there's generally a way with which you can probably spread it off in some way, shape, or form to make it beneficial to you and give you the amount of delta exposure that you're looking for. So long story short, if you don't want to play the roll game and you don't want to play the option pit predictably crappy game, however you would put it, trade the futures or futures options.
Or just tune into our program This Week in Futures Options, where we break down all of that fun stuff. Shameless plug for our newest addition to the Options Insider Radio Network. We actually just recorded it because we're doing it a little bit early again. Our schedule a little bit in flux this week as we deal with all the travel for our team. Speaking of, I love some of the live questions that come in via this. We got this one coming in via Wall Street Addict. I think this is via Twitter, maybe Stock Twits. He's asking back about the GDX puts. He wanted to know, we were joking about, the 100,000 contracts they did. He wanted to know if they were selling or buying. The answer is they were both. It was indeed a roll from the 24 down to the 23 strike. So they sold out about 50,000, bought in about 50,000. So net both. But at the end of the day, he really did just loved his broker. He loved him. He loved him up so much. All right, let's got time for. Let's see one more here. This one. Let's skip down here for some interesting one. This one. Unless you want to talk about Chinese gold arb. Let's move on to this one. Let's see. Regarding options trading volume. This one comes just from Nick. He says, regarding options trading volume, is there an increasing percentage of trading done by a small number of firms? Are spreads widening or tightening? This is interesting, kind of a bit of a loaded question. We discussed it, I believe, with Brian on his show, the Options Playbook Radio, last week at the Options Industry Conference. You can check it out on our network now if you haven't. But it's an interesting one to discuss here on this program as well, because it is indeed kind of like I said, a bit of a loaded question. And it kind of depends really which side of the space you're coming from, the answer. Because on the one hand, the space that Andrew and I came from, the market-making trading community, that community is obviously contracting aggressively. So the notion that is a larger percentage of trading being done by a smaller number of firms on that side of the space, yes, without a doubt. There's a handful of large liquidity-providing firms left in this business, and they handle pretty much all of your order flow. So if you're talking from that perspective, then the answer is yes, there are fewer firms. On the flip side, on the customer side, on the paper side, as we refer to it a lot here on the program, are there fewer firms or more firms? Well, undoubtedly, there are a lot more firms. Customer base has been growing quite a bit on the institutional side, at least, for options for a long time. That's reflected, of course, in a lot more financial advisors and asset managers getting into the options realm, as well as more, funds and other things coming into the space and learning about the efficacy of the product and deciding they want to buy a put or do collars or write calls or whatever the case may be. So that has accreted to a lot of new customers on the institutional side, and certainly a lot of retail out there as well. So kind of depends which side of the space you're looking at. If you're looking at, are there fewer firms or are there more? There's two answers to that same question. The same is for the spreads. That's an interesting question as well. Again, if you're interested in stuff, I encourage you to check out our panel audio from the OIC 2016 conference. We actually featured Henry Schwartz from Trade Alerts, our friend over there on Trading Tech Talk, his presentation on this exact subject, getting into all this stuff, nitty-gritty on spreads, market makers, all that kind of stuff. We're going to feature that on our network as long with his presentation, so you actually can follow along with his charts. I also had a great conversation with Henry on our Trading Tech Talk program that's coming out on the network soon as well, where we get into a lot more detail of his presentation, because he has all the data over there at Trade Alert, and he's been looking at a lot of these issues. And in some areas, spreads are indeed widening. That's a bit illusory, though, because what we're seeing is, of course, a lot of the volume actually going up in what are known as price improvement auctions in a lot of the space now. So you might see smaller size and wider markets being displayed when you look at a quote for name X, but reality the market is tighter. The market makers are just waiting to show their best bid and offer until when the order actually comes in. Then they compete in the price improvement auction. So the real market is actually within that auction mechanism. A lot of people are now pushing back on that, saying, hey, that's kind of ruining the displayed liquidity and causing all kinds of other issues and widening out spreads as a result. So it's a bit of a contentious issue there. But yeah, spreads on the surface appear to be widening, but it kind of depends on a product by product and case by case basis what's actually going up on there, and then you have to look at some more nuanced things like the price improvement auctions to see exactly what's happening in some of these names. And of course, your front month Apple and SPY and Qs are always going to be a penny or two wide, and that's probably not going to change anytime in the foreseeable future. So again, it depends what product you're looking at in terms of how this stuff sets up. Mr. Rock Lobster, anything to add here? Let's see. He wants to know, trading volume is an increasing percentage done by a small number of firms, and are spreads widening or tightening? Anything to add to that, sir?
I almost want to be silent just to go along. So.
Stunned silence. Okay, fine. The two of you are stunned into silence by my lengthy and epic answer. Unfortunately, my answer was so lengthy and epic that kind of takes up all the time we have for the mail block this week. Keep them coming. Love the questions. Love your feedback. However you get it to us, live, via Twitter, via the website, via however. Carrier pigeon to the studio. We'll take them all. We'd love to hear from you guys. Meanwhile, it's time for us to keep on rolling into our final segment. It's time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. Like the name implies, this is indeed the portion of the program where we have, I'll tell you what we're watching for the week to come. Again, it is kind of the tail end of earnings. We do have a few names still reporting. That market mover known as Campbell Soup coming out tomorrow, as well as Deere and Foot Locker. So if you're interested in any of those names, you got something to trade tomorrow. Also checking back in on our friend Gap. They were gapping up, and now they're kind of letting off the gas a little bit, only up about 3.5% or about 60 cents. In the after hours, hovering right around the $17.90 mark. So apparently the near-term flurry in Gap shares was just that. And of course, we had Miss Topham Hat kind of putting out their viewpoint this week. So kind of obviating some of that. Their data, at least for the next few weeks, they're going to announce their decision on the 15th. So I think everyone's kind of playing a wait and see, at least in June 15th, from the Fed for that sort of thing. But aside from that, there still are a few things to keep an eye on. Let's start in the realm of Uncle Mike. Uncle Mike, what are you watching for the rest of this week, in addition to all of your roll yield on your various ETF positions?
Right. Tomorrow is the 1-year anniversary of the all-time high of the S&P. We set on SPY anyway. We were at 213.78 a year ago, or I should say tomorrow it'll be a year since that's happened. So the fact that if you just look at a chart of the S&P over the course of the last year, we're down a little bit, but we had two big drops. One of them was back in August, and then the other one, of course, was in the beginning of this year. So in looking at it, we've been in this channel for a while now. We've been in this channel longer than a year. Everyone knows that. But what's concerning to me is that, and what I continue to say is that, yes, I am a bull on this market, but we got to get through that hurdle, and the hurdle is 213.78 at this point on the S&P, and we're at a 1-year anniversary of it tomorrow. I think that could be of some significance in the next few days. 2
words for you, sir: death cross. We can't come back. You can't come back from that. There's no escaping the death cross. It is indeed inevitable, sir. We will now sell off approximately 38%. So prepare yourself for that. Meanwhile, while we're preparing for that inevitable sell-off from the oh-so-sexily named death cross, Mr. Rock Lobster, what are you keeping an eye on for the rest of this week into the old weekend, sir?
I found that death cross thing to be very interesting. Somehow they always come up with 2 in the last 20 years. Now, did they go back with the death cross like over the last 50 years or 40 years or, I don't know. But
that's always the question with this stuff, isn't it? The frame of reference on the data and everything else, you could construct anything however you want it to look, It just sounds cool.
Well, it does sound it. No, it was super cool. But then it was also they crossed before on a rally, it looks like, too. So I'm trying to figure out if the one has to drop to the other. It sounds like it's a certain kind of cross. But anyway, as far as the market, the fact that we haven't been able to make new highs, I just think there hasn't been a reason. I think the market is still trying to shake the QE out of itself. And until the market really shakes the QE out, we won't make new highs. It's as simple as that. You still have 2 major economic blocks with negative interest rates. So that's to me is still Goofyville. So the market needs confidence to rally. When the U.S., I guess, had whatever their economic policy was that was sort of clear as far as rates went, things were kind of buoyant. And ever since they become cloudy, we have what we have. And with the Sir Topham Hatt reference, nothing's changed as far as making things cloudy. So I agree with Mike that things don't look horrible, but it's hard to get, go bull, buy call bullish. Individual names, fine. There's going to be stocks that are going to outperform, but I would be hugely surprised to see the S&P 500 make a new high this year without coherent and steady interest rate policies out of the G7. I just don't see that happening, but I could be wrong.
It's been known to happen. And I think all of life should be able to be neatly summed up with a nice Thomas the Train Engine reference. Unfortunately, that music means it's time to bring to a close this very Thomas-heavy episode of the Option Block. And before we go, one last time, I'm checking with each of my cohorts, my partners in crime on the old Option Block. Let's start with you. He of perhaps not a fan of Thomas. I don't know, Uncle Mike, if you're a fan of Thomas or not, but tell us what you are a fan of, what you're keeping an eye on, and what folks should reach out to you for over there in the land of all things going long.
Got it. Now, my son just read either option books or football books growing up. He never was into Thomas the Train or anything like that.
So no fun was had for him.
Well, what could possibly be more fun than watching football and listening to the Option Block, by gosh. But anyway, if you are interested in having someone else manage your money who understands options and who can possibly incorporate them into your portfolio for the long term, feel free to reach out to me. I am at 312-212-3531, or send me an email at mtusaw@rcmfs.com. Folks, even if you have like $50, $100 a month, something, feel free to give me a call. I work with a lot of people that think that they don't have enough money to work with me, but give me a call. You probably do.
You'd be surprised how little it takes to roll some puts. So give Uncle Mike a call. He'll roll your puts for you. So it says it right there on his business card. And it does, because I printed up a bunch for him. I'm going to give it to him now that say, I'll roll your puts for you. So he'll be using those forthwith. And, of course, Mr. Rock Lobster, what's coming on the pike in the land? Oh, the pit. And don't tell me you're building a new Thomas the Tank Engine train table. That sounds pretty fun, actually. I wouldn't mind doing that myself.
I did do that once, actually, for my kids. They still use it, but it's now morphed to the Lego table. Anyway, what do we got? We got June 11th, condors and butterflies. What makes them good? What makes them stink? Saturday class, June 11th. And I guarantee you it will help your condor and butterfly pricing and trading. I absolutely guarantee it will help.
What does make a condor stink? What makes a smelly condor? I don't know.
Selling the vol into the hole and getting way too short. That's one of the
That's what makes a condor stink. You took the words from my mouth.
I was going to say maybe they ate too much carrion, because I was talking like condors and vultures, so they smell like carcasses, but that's a little bit too specific, I'm sure.
They're actually very clean creatures, condors. You didn't know that?
I did not. I don't follow my carrion birds as precisely as you do, apparently, up there in the hinterlands of Maine.
They circle. You got to be careful. Your little dogs will be taken away.
And where can they go to find all things stinky? That should be a good name for your webinar, actually. Stinky Condors.
Stinky Condors. What makes a condor stinky?
Where should they go? Where should they go?
Butterfly's wings to fall off.
There you go.
I have another client. I got to go.
Where should they go for all things learning about your webinar, sir? Where should they go?
www.optionpit.com/events.
There you go. It's like he's done this before or something. Listen, he's got to pull teeth to get him to give you the URL. But there you go. Check it out if you want to learn all things stinky condors for yourself. And on behalf of the stinkiest of rock lobsters and Uncle Mike, and indeed myself, I want to thank all of you out there listening audience for downloading, streaming, subscribing, for sending in such great questions, and of course for streaming us live if you are able to do so. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.